Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk.
Yeah.
And today we're looking at NextNRG.
Yeah, and quickly before we jump in, if you find our talks useful, please consider, subscribing, liking, and commenting underneath. We really appreciate the support as we try to decode the market for you every single day.
Absolutely. It really helps out.
So, NextNRG. Usually when we talk about energy infrastructure, I feel like everyone's eyes just sort of glaze over.
Oh, completely.
It sounds like, utility poles, digging trenches, steady but super boring dividends.
Right.
But then you get a ticker crossing the desk like NextNRG, and suddenly the math starts looking, well, it looks a lot more like a tech startup than a traditional utility company.
It really does. And I think that's the friction point we're looking at today.
Yeah.
Because this isn't just about pipes and wires anymore.
No.
It's about a company claiming to sit right at the intersection of AI, mobile energy, and smart grids. And honestly, usually when I hear that specific combination of buzzwords, I run the other way.
Yeah, I mean, it sounds like a pitch deck designed to just trap venture capitalists who have, too much money and maybe not quite enough time to do real due diligence.
Exactly.
Yeah.
Just pure vaporware. But here's the thing, and this is really why we're digging into this today. The numbers coming out of NextNRG suggest it's actually not vaporware.
They actually have the numbers to back it up.
They do. They are hitting what looks like a genuine, massive inflection point. We're talking about a company that just posted revenue growth that, frankly, you rarely see outside of, like, Silicon Valley software.
But they're doing it with physical industrial assets.
Right, which is incredibly hard to do.
Okay, so you definitely got my attention. You mentioned growth that looks like software. Let's put an actual number on that for everyone listening, because usually in the energy sector, high growth means what, like 5% a year?
Yeah, if you're lucky.
Right. So what are we actually looking at here?
So the headline statistic here is the third quarter of 2025. NextNRG delivered $22.9 million in revenue.
22.9. Now, to be fair, for a mega cap company, an Exxon or a Chevron, that's a rounding error. That's basically what they spend on coffee filters for the break room.
Sure.
But for a company of this specific size, context is everything, right?
But no, context is the whole story here.
Mm-hmm.
That $22.9 million represents a 232% increase year over year.
232%.
Yes. To visualize that for a second, in just those 3 months, they nearly matched their entire revenue for the full year of 2024.
Wow.
Yeah, that is not some gradual improvement. That is a total step change in their business.
Okay, I have to play the skeptic here, though, because that number is almost too good.
Sure.
When I see triple-digit growth like that, my first thought is usually M&A. Did they just go out and buy a bigger company and basically staple that new revenue onto their own income statement? Or is this actual organic growth from, selling more product?
It's a mix,
Yeah.
but the organic execution is absolutely the real driver here.
Mm-hmm.
They have a division called ESFill, which is their mobile fueling unit. Think of it kind of like Uber for gas, but targeted at commercial fleets.
Right.
And they aren't just blindly adding more trucks to the road. They're getting significantly better utilization out of the ones they already have. They're sweating the assets harder.
Sweating the assets, basically making sure those trucks aren't just sitting idle in a parking lot somewhere eating up insurance costs.
Exactly. If a truck is parked, it's losing money. If it's out moving fuel, it's printing money. And they've really optimized that logistics side.
Got it.
And then they're combining that cash flow with their emerging smart microgrid segment.
Which is the AI side of things.
Right. So you have this somewhat legacy business of physically moving fuel around, which is growing nicely, effectively funding the high-tech, futuristic business of building intelligent grids. It's a strategy that's actually working in the real world, not just theoretically on a whiteboard.
So the top line is completely exploding. That's the elevator pitch, basically.
Yeah.
But we've seen plenty of companies grow themselves straight into bankruptcy. You know the old joke, we lose money on every sale, but we make it up in volume.
The classic startup trap.
Right. So if revenue is up over 200%, are their losses up 200% too? Because scaling a physical truck-based business is extremely expensive.
And that is the million-dollar question. Actually, it's the multi-million-dollar question here. And this is where the thesis gets really interesting for me. Because if you look at the margins, they aren't deteriorating.
Okay.
They're actually expanding.
Walk me through that, because usually when you grow that aggressively, things break, operations get messy, and you lose efficiency.
Normally, yes.
Yeah.
But in the previous quarter, their gross profit margins were hovering right around 8%.
Okay.
In Q3, that jumped to 11%.
11%. Okay, so 8 to 11. A listener might hear that and think, big deal, it's 3%. Why should I actually care about a 3% move?
In the world of low-margin physical infrastructure, that is massive. That's a 300 basis point jump in 90 days. It proves something called operating leverage.
Operating leverage. Let's actually define that quickly for everyone because we throw that term around a lot on Wall Street and it's super important here.
Sure. So it basically means that as you add more revenue, your costs don't go up at the exact same rate.
Yeah.
Your fixed costs, so that's the headquarters, the core software development, the executive base salaries, those stay relatively flat.
Right.
So every new dollar of sales you bring in drops a lot more profit straight to the bottom line. Moving from 8% to 11% suggests they are really starting to see those volume discounts from suppliers.
They're negotiating better rates because they're bigger now.
Exactly. And they're streamlining their logistics. They are moving down the cost curve.
Okay, so they are becoming more efficient as they get bigger. That's the classic economies of scale kicking in. But are they actually profitable, or are they still just kind of burning the furniture to keep the lights on?
They are still losing money. We have to be very clear about that fact.
Yeah.
But the trajectory is the key thing to watch.
How fast are they burning it?
Well, in Q2, their operating loss was $5.2 million. In Q3, that loss narrowed to $3.4 million.
Oh, wow.
And keep in mind, that excludes stock compensation, which is a non-cash expense anyway.
Right. So revenue is shooting up and the losses are shooting down. That is exactly the graph you want to see. It's the closing of the jaws, so to speak.
Precisely. And management has explicitly stated they are, quote, moving closer to positive cash flow. Based on this current trend line, reaching EBITDA break-even isn't just some pipe dream anymore.
EBITDA earnings before interest, taxes, depreciation, and amortization. Basically are the core day-to-day operations making money before the accountants get involved and move things around.
Exactly. And hitting that break-even point looks mathematically achievable in the near term now.
And that changes the risk profile completely. Because if they can pay for their own growth without begging Wall Street for more cash every quarter, they control their own destiny. Right.
But speaking of begging for cash, how is their balance sheet? Because if they run out of money 1 month before they hit that profitability milestone, it's game over.
They've actually been doing some serious financial spring cleaning lately. They've recently refinanced their entire truck fleet and converted some of their debt into equity.
Converting debt to equity, that usually dilutes the existing shareholders a bit, but it cleans up the books, right?
It does. It removes the immediate crushing pressure of interest payments and principal repayment. It extends their runway.
So it's a survival move, but a smart one.
It's a proactive move. They want to ensure they don't have to go hat in hand to investors at a desperate moment. They are positioning themselves to cross that finish line to profitability using the resources they already have in-house.
Okay, so financially, they really seem to be tuning the corner. But let's pivot and talk about the actual product.
Yeah.
You mentioned AI energy infrastructure earlier.
Yeah.
Now, we both know AI is the marketing glitter of the decade right now. Everyone slaps .ai on their website and just calls it a day to bump their valuation.
Yeah.
Definitely.
Is there any actual there? Or is this just marketing fluff to pump the stock?
I am extremely skeptical by nature when I hear AI thrown around in the energy sector. Usually it just means, an Excel spreadsheet that updates automatically.
Right, a macro.
Exactly. But NextNRG has something they call the Utility Operating System, or UOS. And what gives me pause here, in a good way, is the academic backing.
Academic backing, like university studies.
Yes. The team behind this hasn't just written corporate blog posts. They've actually published peer-reviewed research papers on grid intelligence, demand forecasting, and microgrid control algorithms.
Okay, that is super rare in the corporate startup world. Peer-reviewed means other actual experts in the field have looked at their math and said, yes, this fundamentally works.
Exactly. They are solving really hard, complex math problems regarding how to balance energy loads on a live grid. Imagine you have a microgrid that has solar panels, a giant battery, an EV charger, and a connection to the main city power grid.
That's a lot of moving parts.
It is. And the AI has to decide, in real time, every second, do I store this solar energy? Do I sell it back to the city grid right now to make a quick profit? Or do I use it to charge the delivery truck?
And it has to predict the weather and future energy prices to make that decision accurately.
Right.
That's incredibly complex.
Yeah.
Humans simply can't do that manually every single second of the day. And if they actually have the proprietary algorithms to do that, that builds a massive moat around their business. You can't just hire a couple of freelance coders and replicate that overnight.
It adds a massive layer of defensibility that most of their competitors just don't have. And this connects right back to that vertical integration we touched on. They aren't just selling the software.
They do the whole thing.
They do the mobile fuel delivery, the renewable power generation, the battery storage, and the wireless EV charging.
It's the whole widget approach.
Yeah.
Why does that matter so much to the end customer, though?
Think about it. If you're a customer, let's say a logistics company with a fleet of delivery vans, you don't want to manage 5 different vendors.
Right.
You don't want one guy for solar panels, one guy for batteries, one guy to gas up the legacy diesel trucks, and another software guy to tie it all together. NextNRG comes in and basically says, we handle the energy, all of it. Just pay us.
That makes them incredibly sticky. Once you install their entire ecosystem, you aren't going to switch to a competitor easily. It's just way too much of a headache to rip it all out.
Exactly. And don't forget the network effects here. This is the flywheel for their AI. As they deploy more assets, more microgrids, more trucks, their AI ingests more real-world data.
Which makes it smarter.
It gets smarter at forecasting demand. It learns, oh, it's a Tuesday in February. Energy demand usually spikes right here in this zip code. And the better the forecasting gets, the more money they save the client.
Which helps them win more clients, which gives them even more data.
It feeds itself perfectly.
Yeah. I love a good flywheel business model. But let's look at the quality of this revenue. We talked about that $22.9 million. But is that just one-off sales? Like, did they just sell a bunch of batteries one time and that's the end of it? Or is this recurring, dependable revenue?
This brings us to what I actually think is the holy grail of this entire investment thesis. They have signed 2 28-year power purchase agreements, or PPAs.
Wait, 28 years?
Yes.
That's longer than most marriages. That's longer than a typical mortgage.
Significantly longer.
Okay.
And think about what that means for you as an investor. It's guaranteed, locked-in revenue. It is pure visibility. For nearly 3 decades, they know exactly when that check is coming in the mail.
That provides such a solid floor for the stock price. It drastically reduces the risk of having to constantly hunt for new customers just to keep the lights on month to month. It essentially anchors that microgrid business so they can afford to take risks in other areas.
It absolutely does. It transforms the company from a speculative, maybe we'll sell something this quarter kind of stock, into a utility-like asset with highly predictable cash flows. It makes the company incredibly bankable.
Because lenders love seeing 28-year contracts. They know their loan is going to get paid back.
Exactly.
So we have the explosive growth, we have the tech moat, and we have the long-term contracts. But markets are forward-looking. We trade on what's going to happen tomorrow, not what happened yesterday.
Right.
What has happened recently that tells us this train is actually leaving the station? I know you track the newswire pretty closely.
There have been some very specific, very bullish signals in just the last few weeks. The big one dropped on February 9th.
Okay, what happened?
NextNRG signed a memorandum of understanding and MOU with NextNRG.
NextNRG. Okay, they're a major player in this space. What's the actual deal structure there? Is it just a friendly handshake for a press release?
It's much more than that.
Yeah.
The deal is that NextNRG will act as the lead partner contractor and the project manager for NextNRG energy projects.
Lead partner? That sounds like a major promotion. They aren't just a subcontractor pulling cables anymore.
No, it's a huge market validation.
Yeah.
It opens up entirely new geographies and new verticals that NextNRG might not have had the capital or reach to access on their own.
They're essentially piggybacking on NextNRG's massive deal flow, but taking a leadership role in the execution.
Right. And it lowers their customer acquisition costs significantly because NextNRG is essentially bringing the work directly to their doorstep.
That is a huge catalyst for future revenue. But I want to ask about something a bit more technical that I saw in your notes before we started. Something about an ATM.
Ah, yes. This is a bit in the financial weeds, but if you really want to understand how management feels about their own stock, this is vital. On January 17th, they terminated their at-the-market sales agreement, which is often called an ATM.
Okay, let's explain this simply so everyone is on the same page. An ATM is basically a standing order that lets the company sell brand new shares into the stock market whenever they want to raise quick cash, right?
Yeah. Exactly. Think of it like a corporate credit card that the company just keeps in its back pocket It allows them to print shares and sell them to retail to pay their bills.
Free.
Investors generally hate ATMs because it dilutes them.
It slices the pizza into more pieces, so your specific slice gets smaller and less valuable.
You got it.
And just the threat of the ATM being there often keeps the stock price artificially down because traders are constantly afraid the company is about to dump 1 million shares on their heads.
Correct. So by explicitly canceling it, they're effectively cutting up that credit card on live television. They're sending a very loud signal to the market saying, we don't need this crutch anymore.
Meaning they have enough cash from operations or other sources to fund their own growth now.
Right.
That is incredibly bullish. It just screams confidence from the leadership team. They're basically telling investors, we have enough runway, we don't need to dilute you right now.
It completely removes a major dark cloud hanging over the stock price. And there is one more catalyst that I actually think is flying totally under the radar right now.
Oh, what's that?
The CEO is no longer under non-compete restrictions.
Oh, really? What was holding him back previously?
Well, previously, there were strict limitations on his ability to participate in certain markets due to his past business dealings. Now that those legal restrictions have officially expired, he can fully participate in the wired and wireless EV charging markets.
That is a massive, total addressable market. I mean, EV charging is the Wild West right now. Every single parking lot and grocery store in America is trying to figure this out.
And remember, NextNRG already has the core technology to do this. Now the CEO is legally free to go out and aggressively chase those massive deals. It adds a whole new layer of potential growth that just wasn't fully priced into the stock before today.
It sounds like the shackles are finally off the management team.
Yeah.
Okay, I'm getting pretty excited here, but my job is to keep us somewhat grounded. We always have to look at the other side of the coin. If this was a guaranteed home run, the stock would be up 1,000% already.
Of course.
What keeps you up at night with a company like NextNRG? What are the actual real-world risks here?
You always have to respect the risks. And the biggest one here, without a doubt, is execution risk, specifically regarding that timeline to profitability we talked about earlier.
Because they aren't quite there yet. They are still losing $3.4 million a quarter.
Right. They absolutely need to hit EBITDA break even by roughly Q3 of 2026, based on the cash trajectory we discussed.
I mean, if they miss that.
If they miss that, say, costs spiral out of control, or a big contract gets delayed, or revenue dips, they might have to go crawling back to the market to raise more capital.
And if they do that after canceling the ATM and acting super confident,
The market will punish them severely for it.
yeah, their credibility would take a massive hit. It's the classic boy who cried wolf scenario.
Exactly. And then there's the broader competition. We talked about their AI moat, but there are absolute giants in this room.
Right.
You have Tesla Energy, you have Sunrun. These are extremely well-capitalized behemoths with massive global brand recognition. NextNRG is an agile speedboat, but those guys are aircraft carriers.
If Tesla just decides tomorrow to start a massive price war in the microgrids space, or if they just bundle their product in a way NextNRG simply can't match because of scale, that's a huge problem. NextNRG just doesn't have the war chest to fight a 10-year battle of attrition against Elon Musk.
It is a major risk. They are fighting for market share against literal household names. That is never going to be an easy fight.
And I have to ask about the macro world stage, too. We constantly see headlines about, Iran nuclear talks, global oil prices fluctuating wildly. Does that macro noise mess with their day-to-day business? Energy is notoriously volatile.
It definitely creates noise in the stock price. You might see the stock bounce around on any given Tuesday just because the broader energy ETF is down that day.
Right?
But fundamentally, I actually see this as a contrarian opportunity.
How so?
Yeah.
Usually geopolitical instability is terrible for business planning.
It is, unless your entire business model is selling resilience.
Ah.
NextNRG focuses heavily on distributed energy. These are microgrids that continue to work perfectly even when the main city grid goes down.
Right, they are islandable.
Exactly. So when geopolitical tension is really high, when corporate executives are terrified about cyber attacks on the national power grid or oil supply lines getting cut off, the inherent value of having your own independent power source goes through the roof.
It's essentially corporate insurance.
Yeah,
You're
right.
selling them pure peace of mind. They can say, I don't care what happens in the Middle East today. My delivery trucks are fully charged and ready to roll.
Exactly. Extreme uncertainty in the world actually serves to validate their entire business model. So while the stock itself might wobble with the sector on a daily basis, the fundamental corporate demand for what they actually build likely increases significantly during times of crisis.
That is a really smart way to look at it. It's almost counter-cyclical to global chaos.
Yeah, it really is.
Okay, we've covered the absolute explosion in quarterly revenue, the
Mm.
clear path to profit, the AI software moat, the incredibly long 28-year contracts, and of course, the macro risks. It is time for the final verdict. We have a tradition here on Smart Wealth. What is the actual score?
All right, so I've crunched all the numbers, I've looked at the near-term catalysts, and I've carefully weighed those execution risks against the massive upside potential. I am giving NextNRG an 8.5 out of 10.
8.5. That is a very strong score from you. We do not hand those out lightly around here.
It is high, but you just do not see 232% growth combined with simultaneously expanding margins and a mathematically clear path to profitability very often.
Usually it's an either-or situation. You get the high growth but terrible cash-burning margins, or you get the great margins but absolutely zero top-line growth.
Exactly. NextNRG is somehow giving us both right now. Those 28-year contracts provide the necessary safety net, and the tech moat provides the explosive upside. It's a really rare combination of downside safety and aggressive growth.
And what is the realistic time horizon for you on this one? Is this a day trade? Are we trying to flip this next week on a news bump?
No, definitely not a quick flip.
Uh,
This is a 12 to 18-month hold, in my view. You really want to give the management team time to execute on those new Neutron X projects and actually hit that crucial profitability milestone later in 2026.
The thesis simply needs time to bake in the oven.
It does.
So patience is absolutely key here. Don't pull up your app and watch the ticker every 5 minutes stressing out.
Exactly. The big thing to watch for is the Q4 earnings coming up in late March. That'll be the next major report card. You just want to see that revenue number stay elevated and those gross margins creep up maybe another percentage point or two. That's your concrete confirmation that the growth story is still fully intact.
Well, there you have it. A high-growth infrastructure play that really seems to be cleaning up its act financially, just as their target market is rapidly expanding. It is definitely one to keep on your watch list.
Absolutely agree.
Thanks for walking us through the weeds on this one today. And to everyone listening, remember, we provide the daily analysis and decode the catalysts, but ultimately, you make your own decisions. Do your own due diligence, read the SEC filings seriously, always read the fine print in the filings, and make sure this actually fits your specific portfolio strategy. And I want to leave you with one final thought to mull over today. If NextNRG successfully proves that AI can fully automate an entire corporate microgrid down to the second, what does that mean for the massive, slow-moving national utilities in the next decade? Are we looking at the beginning of the end for the traditional centralized power grid entirely?
Something to think about.
Definitely. We'll see you next time for another episode of Smart Wealth with Joshua.